This just crashed by 52%. I'm your host, Steve Van Metre, and thanks for joining me today. In our lead story today, you might own this in your portfolio, which is why we're making the call that you need to get out now before it goes to zero. Plus, we're seeing new evidence that the U.S. labor market is about to implode. At the same time, political elites are lining up around the world to do the unthinkable. Now let's head over to Bloomberg, where we picked today's story up with a headline: as Moody's cuts debt on offices backed by PIMCO. That's right, you might own them in your portfolio. You need to check your bond funds to the lowest level, because now you're about to see prices come crashing down. The $484.7 million commercial mortgage-backed security is the most senior debt of up to $1.72 billion of mortgages on the portfolio of 7 buildings in New York, San Francisco, New Jersey, and Boston that originated back in 2022. The downgrade reflects the expectation of further accumulation of interest shortfalls in the outstanding advances, which increases the aggregate loan exposure and the potential for principal losses. And again, if you own PIMCO bonds in your portfolio, you may want to take a look at the underlying holdings and make a change, because this is only going to get worse. As U.S. offices continue to fall in price, led by declines in central business districts, where values are now down 52% from their 2022 peaks. The delinquency rate, and this is a huge red flag, on office commercial mortgage-backed securities climbed to 8.09% in July from 4.96% a year earlier. And this is exactly what happens when financial conditions tighten. When you see central banks invert the yield curve, what that means is they drive short-term rates up higher than long-term rates, and this causes a dislocation in the market. And the action by the banks is to curb their lending activities, because banks borrow at the short end of the curve, lend at the long end, and make money on the spread. So when they can't make money on the spread, they curtail their lending activities, and that means what we're seeing right here on this chart as a net percentage of domestic banks tightening standards for commercial industrial loans to firms of all sizes, here shown in blue. This is the reaction. As central banks tighten, you see any point where the blue line is above that horizontal black line, that means on net banks are making it more difficult to get a loan. And when they do that, that limits the creation of money into the economy, because commercial banks are the only entities that can create money in our debt-based system. And so here you can see, of course, going back to 2022, when the Fed inverted the curve, banks started tightening lending standards, and look what happens to delinquency rate. Now we're looking at all loans at commercial banks here in red, but as the commercial banks tighten lending standards, there isn't enough money to pay on all the debts, and sure enough, you see delinquency rates rise. And look what happened during the global financial crisis. It got out of control. This time, you see it's fairly subdued, and much of that has to do with the fact there was still pandemic stimulus sliding around in the economy, but now that's all dried up, indicating that, as we see in the data, commercial and delinquency rates are headed higher, which means the underlying asset values are going to plummet. And funds managed by PIMCO acquired the office portfolio's owner, Columbia Property Trust, in 2021. The trust defaulted on the debt in January of 2023 after interest rates rose and demand for office space continued to weaken following the pandemic. And the buildings were 76% leased as of June 30th, down a whopping 85% when the debt was originated in 2022. And the crazy thing is, when we look at the labor market, it's going to get worse. But instead of looking at your portfolio and see it down, how about you see it head up? Let's take a look at our win rates right now. As of the close of business Friday, our CTA Timer Pro, this is 27 open trades. 26 of them are up right now. That's a 96% win rate. Momentum Timer Pro, all 14 trades are up. You want to make money trading? You want to make money investing? We show you how to do it. Now, maybe you want to beat the machines, and we show you how to do that. When we see the machines get in deep short position, and we run this across equity, bond, currency, and commodity markets, and then price rallies against them, well, that flags on our reports. But maybe you like to trade momentum, but we look at momentum in a different way. We aggregate all these technical signals like the RSI, the MACD together, and we run a proprietary overlay, and then we look at long periods like the 1, 3, and 6 month range. When we see a reversal and shift in momentum on the daily count, that flags our reports. And you can get both reports, the tradable signals. I give you my opinion on which ones I think are the best ones you should take. I give you stop loss levels. We track every trade in return so you can duplicate them perfectly. That's the difference about what we offer. You can't copy what our buddies are doing because no one understands their data, but you can copy mine exactly. And we give you a weekly update, as we did today, on all the positions, all the stop loss levels. Here's the best part. You want to make money trading? You want to be a better investor? Hit the links in the description below. You get a 30-day free trial. None of my buddies do that. They make you pay, and because they need the money when they find out that you can't make money using their system. But let's look at the labor market now, and this is why we're going to see the office space get worse, because as people lose their jobs, that means businesses don't need as much space, leaving these buildings to potentially plummet in value. As now expectation of losing one's job at a record high, this according to a New York Fed survey. The share of people who think they're likely to be unemployed in the next 4 months reached a record high in a Federal Reserve Bank of New York survey of consumer expectations that dates back to 2014. So all of a sudden, we see this huge shift from Jackson Hole, Wyoming, when Fed Chair Powell got up and pretty much said he's focused on the labor market right now and that he's concerned and is set to cut rates in September, now suggesting it's only a matter of how much he cuts and then how many times he's going to follow up on that, because we're seeing signs that the labor market is starting to unwind, and this validates this. At the same time, there's a rising number of consumers who expect to receive a job offer in the next months compared with that to a year ago. Overall, the New York Fed survey shows increased churn in the labor market, as well as workers who are increasingly dissatisfied with their wages and benefits and holding on to high pay expectation levels. But the notable part here is they're expecting to receive a job offer, but the economy isn't creating jobs. In fact, we have an issue with the unemployment claims where people are sitting on long-term employment with no opportunity to re-enter the market. So the fact that we're seeing workers say they're likely to lose their job, but they're hoping to get another one, the reality of the situation is there is no other job. They just don't realize it yet. Because when we look at manufacturers' new orders, this is, of course, the durable goods data from the government. When we see a decline in demand and new orders go down, what happens is manufacturers don't need as many employees. They start cutting hours, they start cutting jobs, and the problem is because everybody starts cutting jobs, there isn't any for the people that are on unemployment. And so you see here, because the reality is when you get on unemployment or you see some of your coworkers get there and they can't get work, the reality is you'll see demand go down, and that's why workers are saying they're likely to lose their job. But as you can see, based on the continued claims data that's not going down, the chances of them getting a job in the coming months is highly unlikely, because we see demand in the form of new orders continuing to plummet. And of course, it makes perfect sense why workers are looking to change jobs. They need more money. When we look at the consumer price index here shown in blue against total compensation, this is average hourly earnings of production and non-supervisory employees multiplied by their average weekly hours, both again shown on a year-over-year rate of change. Because according to the government data, we see that workers are actually ahead of inflation, but we know that's not true, because when we look at the actual CPI, we know it doesn't take into account, say, insurance costs. It doesn't take into account debt service costs and other factors that just don't show up in the data. So while from the government's perspective, workers are ahead, in reality, they're not looking to change jobs. The problem is there aren't any. And the reports highlight increased turnover as the rate of transitioning to a different employer rose to 7.1%. This is the highest reading since the survey started, and this is being done because people are looking to make more money. But get this, the share of people who had a job 4 months ago and are still with the same employer was at a record low of 88%. So what we're seeing is people get jobs, find out that's not working out, or perhaps there isn't a lot of business coming and they're looking to change, looking for something solid, and they're not finding it. And while churn increases, workers are holding on to their pay expectations. The average reservation wage, the lowest wage at which respondents would be willing to accept a new job, remained near record highs at slightly more than 81,000. It's up almost 20,000 since March of 2020, and it makes perfect sense. Inflation's gone up. Workers fell behind. They took on a lot of debt, hoping the economy would turn in their favor, and it didn't. At this point, the Fed did bring inflation down if you believe in the magic of central banking, but at the same time, there's a nice historic evidence that when you bring inflation down, there is a point where you destroy the labor market and demand, and that's exactly what's happening now. The percentage of people saying they're likely to work beyond 62 bounced off record low of 45.8%, reached back in March of 2024, now increased to 48.3% as the expectation of even working beyond age 67 increased, just going to show that how far workers are behind on inflation, and they've taken on debt to do it. They're being forced now to work longer than they want, and they're going to find out when they lose their job, it's only going to get even worse. But now we turn to the political elites around the world as major central banks now are aligned as Powell signals Fed cuts ahead, and this is a sigh of relief for every central banker around the world who's been waiting for the Fed chief to finally signal it's time to cut. And if you think about this, this is all because of currencies and the belief the central bankers, through their policy, control the value of the currency. So why other central bankers want to cut and are desperate to cut? They really needed the Fed to do that. Finally, Jerome Powell stepping up to the plate. And among the ECB officials, some consensus appeared to emerge around 2 more cuts this year, including a September move, as long as inflation remains in line with the bank's projections, which they see coming down to the 2% target in the second half of 2025. But if we hit a recession, it's going to be there far, far sooner. In fact, the Bank of England governor was also due to address a Jackson Hole gathering on Friday, and in prepared remarks released ahead of his speech, he signaled an openness to further cut rates when he said the risks of persistent inflation appeared to be waning, and what you're going to see all around the world. And we talked about this in the show the other day. When central bankers cut, it is not a good sign. It means we're headed into recession. The problem is they want you to believe that rate cuts will make a change. In fact, they do absolutely nothing. Once you start to see labor markets and demand around the world fall apart, it's game over, and there's nothing they can do to stop it. Indeed, Powell gave a full-throated call to support the jobs market as he cited the recent rise in unemployment rate to nearly a 3-year high of 4.3%, calling the cooling in the labor market unmistakable and adding central bankers wouldn't welcome any further increases, suggesting if that number does go up at the next release, that is going to be a huge red flag. The market is going to start to price in potentially a second cut at the September meeting. And we will do everything we can to support a strong labor market as we make further progress towards price stability. The problem is when the labor market goes, there won't be any price stability. That means prices are going to continue to come down. Inflation is going to overshoot its 2% target to the downside. And once again, central bankers are going to be the ones that send us into recession. And you can see, of course, how far the Fed is behind their own curve, and again, why policy makes absolutely no difference. You'll hear the unemployment rate, as Fed Chair Powell mentioned, now breaking above 4.3%. But let's go back in history here to the 1990s. You see the unemployment rate rising. The Fed cuts rates. You'll notice it did nothing. How about during the dot-com bubble? It burst. The unemployment rate went up. The Fed cut rates. It did nothing. How about the global financial crisis? The Fed tried to cut a little earlier, didn't stop what happened then, and here you see now it's not doing it. Of course, as we went into the pandemic, the Fed started cutting. This was because the yield curve inverted, not because of the labor market. Remember, Powell knows what he's doing when it comes to these money curves. That time he jumped on it. This time he said, no, we're going to let the inversion stand. Here you see the unemployment rate rising. No sign that this is going to slow down at all. And as we look at the real-time SOM roll, what this indicates is indeed we are in recession and the Fed is too late to the curve. Again, if you believe in the magic of monetary policy, here you can see the SOM roll breaking over its trend line back in 1990, signaling recession. Did it again in the dot-com bubble, global financial crisis, and it's already started now. It is game over now for policymakers. In fact, one former Treasury chief, Larry Summers, says the Fed recovered from an egregious inflation mistake, but he doesn't believe that rates are going to come down as much as everyone thinks. We think they're going to zero, as we all made a lot of mistakes. And the important thing is, when you make a mistake, is to recognize and fix it. And while the former Treasury chief said it's now the right thing to do to cut rates at the Fed's September meeting, he argued that we need to be rather more cautious about the medium-term outlook for monetary policy. The reality is, Larry, we're headed into a massive synchronized global recession. There isn't anything to be cautious about except how far and fast every central banker is going to be back to zero. And some are saying you'd be surprised if the Fed is able to bring interest rates down by nearly as much as the market is expecting over the next 2 years. And what he's suggesting here is that he believes that the Fed could raise rates now and it changed the game, that we are now in a structural era where you don't need to bring rates down to new lows. And yet throughout history, what we see is central bankers bring rates down to another new low each cycle. This time, everybody believes a change. The reality is the floor for funds rate is zero. It's been there not once, but twice, 3 times. We'll see it again. Because he's looking to the derivatives market, which reflects expectations for policymakers to lower their benchmark to around 3% in 2 years' time, with the current range right now just between 5.25% and 5.5%. The reality is it's going a whole lot lower. And I think the Fed's making a serious mistake by believing that the neutral interest rate is so low, and therefore is misjudging how restrictive any given level of policy is. And if you don't have the right North Star, you don't navigate very accurately. Hey, the problem, Larry, is they don't have a North Star. They don't have anything. They don't know what the neutral rate is. They're clueless. All they know is when the economy hits a recession, you lower rates. And if it doesn't work, which we know historically it doesn't, you keep lowering it until the magic mystique of the monetary policy does something, which of course means they're going to go to zero. It doesn't matter what the derivatives market says. It doesn't matter what anything. We're about to see, of course, commercial real estate continue to plummet in value. At the same time, the U.S. labor market's going to unwind, and that means funds rate back to zero before too long. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.